Hey, it's Josh Thomas at Academy Mortgage. How you doing? Hey, I just wanted to come at you real quick and share something. I'm sure you heard in the news about the Federal Reserve and what they were doing, and I just wanted to kind of take a minute and talk about that because I think a lot of people, one, they don't really understand the Federal Reserve. Who does, really? But some of the things they've been doing the last few years, I just wanted to take kind of a couple minutes and just talk about that. And so here's an article I was reading, and I'll try to put this in the video or below the video in the comments and stuff like that if you wanted to read through this article. But the Federal Reserve is made up, well, I'm not going to give you all that, but I guess Federal Open Markets Committee is made up of several Fed presidents and some meeting that they have every 6 to 8 weeks. And in those meetings, they talk about what they need to do for the economy and stuff like that. Anyway, years and years ago now, during the crash, they came out with quantitative easing 1, quantitative easing 2, and quantitative easing 3, or I think we call it infinity. And then, of course, they stopped all that. But this is the part that's really important for people to get. Those QE programs created a demand. Well, you got to back up even another step. So let me see if I can show you this here for just a second. So this is a Fannie Mae 30-year bond chart. Remember, and a lot of you guys have seen this. I talk about it with almost every client when they come into my office and stuff like that. But this Fannie Mae bond is something that's sold on Wall Street or in Chicago when the bond fits. And this bond represents interest rates every single day. As the demand for this bond increases, so does the price, obviously. And as the demand wanes, then the price also wanes. And so let me give you a quick snapshot of what this bond will look like. So this is last year, right after the election. This is right before the election. And the uncertainty in the markets created a lot of demand for this particular item. Now, the higher the demand, the higher the price, as you can see, but that also means the lower the interest rates. And so go back 10 years, 7 years ago when we were crashing and everything, the Federal Reserve realized they knew about this relationship, and so they announced quantitative easing 1 and 2, where they announced that they were going to start purchasing this mortgage-backed securities and treasuries as well. So treasuries are similar items, but represent a different type of debt. Anyway, so they started purchasing these. It created a lot of demand. As the years go by, and QE 1, 2, and 3, the demand continues. But then eventually they stopped doing it. That was the spot where most of us in the industry, in my industry, thought, okay, prices are probably going to come down because the demand has gone down. However, that didn't really happen. So we expected interest rates to go up, but they didn't really go up. And so a lot of us were kind of scratching our heads as we understood they should be going up. These prices should be dropping. Anyway, and then of course a year like this shows up where uncertainty is really high here. These are some of the best rates, by the way, we've had. Other than 2012, this is one of the best sets of rates we've ever had. And so when the election came to an end, and you can see the uncertainty of the market cleared up, and a ton of money started flowing out of this market, demand waned, and the prices dropped to the floor. And FYI, the difference from here to here in an interest rate, if somebody came in my office here getting pre-qualified or wanted to refinance, to here, and we lock in their interest rate, that was 1.25% higher. The interest rate was 1.25% higher. Crazy, crazy change right there. Well, anyway, and as you can see, it bounced around a ton, and that's kind of a normal market type of thing. It moves depending on what markets or what things are going on in the market. As you can see, we've kind of come back up here, and we're right here right now, which is better than it's been a lot of the time, but not as good as it was last year. Well, anyway, what's the point of all this stuff? Why am I showing this? Well, the demand for this continues to be high. Why? Why? Well, this is why. The Federal Reserve, through quantitative easing number 1, 2, and 3, acquired a $4.5 trillion portfolio of bonds. $4.5 trillion. Not all of that is mortgages. $1.8 trillion of that is mortgages. Well, if you own $1.8 trillion of an asset, as time goes by, that asset is going to pay out. Mortgages get paid off. Things like that happen, and what happens is the Federal Reserve is constantly receiving incoming money, about I don't know how much actually, 20 to 30 billion a month, I know for sure, that they're receiving in paid off mortgages. for the last couple of years since QE3 ended, they have continued to use the 20 to 30 billion a month. They've continued to repurchase more mortgage-backed securities and more treasuries with those as the bonds have matured. So, if that all made sense, the next will make really good sense. That 20 to 3, or we'll just say 25 billion a month of paid off mortgages that they've been receiving through just normal ebb and flow, people selling their houses and stuff. They've been using that to continue to reinvest in the bond market, which has continued to keep demand for the mortgage-backed securities really high, keeping our interest rates low. That demand has been the number one purchaser of mortgage bonds since years ago now. Well, this article and the announcement this week, which I never talk about these in most of my stuff because most of the time we know that what they're doing months before they do it, and it doesn't really affect the markets that much. But this one, even though we knew about it, I wanted to explain it because when they decided that they're going to start, what they're going to do is right now they're purchasing roughly 25 billion a month in mortgage-backed securities as the old assets get paid off and they have new funds come in from those payoffs. They're using that to purchase new ones. Right now, they just announced they're going to start trimming that back. So if they receive $25 billion in paid off mortgages, they're only going to invest $21 billion of that, and they're going to keep the other $4 billion. Does that make sense? And then in a couple more months, they're going to increase that. So instead of, if they get $25 billion, they're going to keep 8 of it and only reinvest, what is that, 17 trillion? 17 billion a month, and only, right? Only 17 billion. But as the months continue to go by, they're going to be reinvesting smaller and smaller amounts. The reason all this matters, and here's the whole point of the video, is that they are the number one appetite for mortgage-backed securities in the market right now. So if they start waning, if they're I don't know what the proper English here is, if they start trimming back their appetite, the market naturally is going to have to take up the difference, but there just isn't that much of an appetite, and so bond prices will continue to fall gradually, but that's going to put upward pressure on rates. Anyway, this has gone way longer than I was hoping, 7.5 minutes so far. So I just wanted to, hopefully that makes sense. Hopefully that's an educational item for you guys. If you know anybody thinking about moving or refinancing, that's what we get paid to do, not to dissect these articles. But I wanted everybody to have a taste of this. I still need to finish my housing bubble articles that I have, so I'll be putting out a couple more of those here in the near future. Anyway, again, anybody know anything about moving or refinancing, please send them our way. Hopefully this is evidence that we can be of great service to people, helping them understand what they need to know. Have a great night. Thanks a lot, and we'll see you later. Oh, yeah. I have to show you this first for legal reasons. So, there you go. Now you can see my legal, whatever it's called. Have a good night.